Hi, welcome all the viewers. Dr. Vijay's lectures on accounting number 21. Final accounts and balance sheet of partnership firms. Let us go to slide 2 where there is a comparison between single owner firms and partnership firms in terms of differences in preparing final account and balance sheet. The basis of differentiation is the first column. The second column refers to single owner firm or sole trader firm, and the third column is about partnership firm. Single ownership firm is owned by single owner, and partnership firm is owned by all partners jointly. In the final account of single owner firm, it ends with profit loss account. Profit loss account shows the net profit or net loss for the period, and that is transferred from the final account to the owner's capital account. And in partnership firms, net profit, net loss shown by profit loss account is brought down to profit loss appropriation account. Division of this profit or loss among partners is shown at this stage. Items like interest on capital, salary to any partner, interest on drawings, it's all assumed expenditures income. Such items are shown in the final account of single owner firm in profit and loss account itself, but in partnership firms, such items are shown in profit loss appropriation account because it is all related to appropriation of profit or loss among the partners. The profit loss interest on capital is shown in debit side, salary to partner also debit side, and interest on drawings on the credit side. In single owner firm, there will be only one capital account and one drawings account. But in partnership firm, there will be as many drawings account and capital accounts as the number of partners. Slide 3 gives the trial balance of ABC and Company on 30 June 2021. Partnership firm of A and his two sons P and C was registered on January 2020 under the firm name ABC Company. The firm has taken up the manufacture of garments while A was doing only retail of garments. In credit balances, A's capital account, B's capital account, C's capital account, loan from Dena Bank, loan from Small Finance Corporation, sundry creditors, sales, returns outwards, commission received, discount received, and provision for doubtful debts, that is, old provision, are there, and total of debit balance is 27,94,530. The debit balance is the trial balance of ABC Company on 30 June 2021 includes A's drawings, B's drawings, and C's drawings, purchase of materials and spares, returns inwards, carriage inwards, wages and unloading charges, power and water charges for plant, and opening stock of raw materials, work in process and finished goods, salaries, rent of new shop building, electricity and water charges of office building, interest on loan, bad debts, general expenses, furniture and fittings, sun debtors, cash at bank, cash in hand, furniture and equipments and tools, and motor vehicles. Total is 27,94,530. Slides 5 and 6 shows additional information necessary for doing adjustments in final account balance sheet. Item number 1 in slide 5, C has brought in additional capital 28,000 rupees on 1st January 2021. The capital account balance of C shown in trial balance as on 30th June includes this 20,000 also. But while calculating interest on capital for this 20,000, it should be done only for 6 months from 1st January to 30th June. For whatever remaining capital is there, that was there from beginning of the period, and so for that it can be calculated for 1 year. Second, interest on capital is to be provided to all partners at 6% per annum. Interest on capital to be calculated and to be shown in debit side of profit loss appropriation account and to be added to capital account in balance sheet. Interest on drawings charged at 6% per annum is worked out as shown below. The amounts are given. Amounts are calculated, so we need not calculate. Interest on drawings is to be shown on the credit side of profit loss appropriation account and to be subtracted from capital account in the balance sheet. Interest on loan outstanding to small finance corporation is outstanding expenditure to be added to interest on loan in the debit side of profit and loss account and to be shown as liability in balance sheet. Salary still due to employees is outstanding expenditure to be added to salaries in profit loss account debit side and liability in balance sheet. Rent paid in advance 14,000 is rent prepaid, expenditure prepaid to be subtracted from rent in debit side of profit loss account and asset in balance sheet. Commission still receivable for the accounting at 12,000 rupees is outstanding income to be added to commission received in the credit side of profit loss account and should come as asset in the balance sheet. Bad debts further written off as intimation is got that final dividend of 50% of 12,000 due from Rajan Company is declared in final settlement. 12,000 rupees is due from Rajan Company. Out of that, Rajan Company has become insolvent and 50% dividend is finally declared. So out of this 12,000, 6,000 has become bad debt. While showing bad debts in profit loss account debit side, along with whatever is given trial balance, this 6,000 should be added. While calculating provision for doubtful debts from sun debtors, not only the 6,000, the whole 12,000 due from Rajan Company should be subtracted because 6,000 due from Rajan Company is surely that we will surely get good debt and the other 6,000 is bad. Both of it should be subtracted and provision to be calculated only for doubtful debts. Okay. In slide 6, additional information number 9. Provision for doubtful debts is to be provided at a rate of 5% on closing balance of sun debtors. But out of the closing balance on debtors, the 12,000 rupees due from Rajan Company should be subtracted for finding out the doubtful debts. Because that 12,000, out of that 12,000, 6,000 is good debts, sure to be realizable, and the other 6,000 has become bad, that you transfer to bad debts account. Therefore, for calculating 5%, provision for doubtful debts is sun debtors minus 12,000. Next, depreciation will be provided on furniture and fittings and motor vehicles at 10% per annum. Calculate depreciation, it is to be shown in profit loss account debit side and to be subtracted from furniture and fittings and motor vehicles in balance sheet asset side. Tools and equipments are revalued at the end of the year at 1,50,000 rupees. Here it is revaluation method of depreciation. The asset is revalued at the end of the year. The value given in the balance sheet, trial balance, closing trial balance, minus this value as per revaluation is the amount of depreciation. That will be shown in profit loss account debit side. And in the balance sheet asset side, tools and equipment should come as 1,50,000 rupees. Now the closing stock of raw materials, work in process and finished goods is given. Closing stock of raw materials and work in process to come in manufacturing account debit side and closing stock, credit side and closing stock of finished goods in trading account credit side. The profit loss sharing ratio of partners is 5:3:2 for A, B and C respectively. After finding out net profit, the final net profit as per profit loss appropriation account, it should be divided among the three partners in the ratio of A, B, in the ratio of 5:3:2 and to be transferred to their respective capital accounts. Now we are starting the solution, preparing the final accounts and balance sheet of ABC and Company for the year ending 30th June 2021. For final account, it involves 4 stages: manufacturing account, trading account, profit loss account and profit loss appropriation account. All the headings come together, but manufacturing account, trading account and profit loss account are there. Profit loss appropriation account is not normally shown in the title. See manufacturing account. In debit side, to opening stock of raw materials and work in process first. Then comes purchase of materials minus purchases returns outwards. Then comes carriage inwards, then wages and downloading charges, power and water charges for plant. Carriage inwards, wages and power and water charges are direct expense of purchase or manufacture. On the credit side, closing stock of raw materials and work in process. We get the cost of goods sold for the period 7,90,200, and that is brought down to trading account. Trading account starts with opening stock of finished goods 85,500. Then we show the cost of goods sold brought down from manufacturing account. On the credit side, sales minus sales returns, and then closing stock of finished goods. What we get finally is gross profit 9,89,930, and that is brought down to profit loss account. In profit loss account, on the credit side, the gross profit 9,89,930 is brought down. Then all incomes come on the credit side, other incomes. Commission plus commission receivable 91,000. Discount received 4,300. All expenditures and losses other than those shown in manufacturing account comes here in deficit. To salaries plus outstanding, rent minus less rent prepaid, electric charges of office, general expenses, interest on loan plus interest due, provision for doubtful debts. Under that, bad debts plus new provision minus old provision. Bad debts means 4,600 shown the balance is trial balance plus 6,000 additional. Now next is depreciation of furniture and fittings, depreciation of motor vehicles, and finally depreciation of tools and equipment. The net profit shown by the profit loss account is 6,12,560, and that is brought down to profit loss appropriation account. Next is profit loss appropriation account. Interest on capital, salaries to partner, interest on drawings, etc. come on the profit loss appropriation account. We have seen it already. Not in profit and loss account as in the case of final accounts of single owner firm. Look at deficit. Interest on capital A, B, C are given, total 9,720. And on the credit side, just below net profit, interest on drawings, total 770. The net profit that remains after making adjustment of interest on capital, interest on drawings is 6,03,610, and that is divided among the partners in the ratio of 5:3:2. So A gets 3,01,805, B 1,81,083, and C 1,20,722. Slide 10 shows interest on capital account and interest on drawings account. While the student is asked to prepare a final account of partnership firms, there is no need of preparing interest on capital account and interest on drawings account. But the two accounts are shown here just to make things more clear to the student. Okay, to the adjusting entry for interest on capital, interest on capital account is debited and partners' capital accounts are credited. So, in the deficit of interest on capital account to A's capital, to B's capital, to C's capital, the interest on capital of all the three partners come. Then, this total 9,720, that is closed, interest on capital account is closed by transferring the balance to profit loss appropriation account. Similarly, the adjusting entry for interest on drawings is by crediting interest on drawings account, debiting capital account. On the credit side, by A's capital, by B's capital, by C's capital, totally 770. Now, this interest on drawings account is closed by transferring its balance to profit loss appropriation account. That's why it comes in deficit to profit loss appropriation account 770. The corresponding postings for closing this interest on capital account, interest on drawings account comes in the profit loss appropriation account. Interest on capital account comes in the debit side of profit loss appropriation account, and interest on drawings come on the credit side of profit loss appropriation account. In slides 11 and 12 and 13, capital accounts of A, B and C are given. There is no need of preparing the capital accounts of partners where the student is asked to prepare the final accounts and balance sheet. But if the capital accounts are prepared, the advantage is so many adjustments that become necessary in capital account, like crediting interest on capital, crediting salaries to partner, crediting profit loss appropriation account, net profit balance, debiting drawings, interest on drawings. All the adjustments have to be exhibited in the balance sheet. To avoid that makes things complicated. To avoid that, it is better before preparing balance sheet to prepare the capital accounts of partners and find out their closing balances. The first A's capital account is shown. Look at it. The balance as per trial balance is 90,000. Interest on capital is credited 5,880. Then the net profit as per sharing ratio is shown by profit loss appropriation account on credit side, and drawings is shown in debit side. Interest on drawings also shown in debit side. The closing balance in A's capital account is 3,85,319. This should come in balance sheet liability side. B's capital account now, balance as per trial balance is 46,000 on the credit side. Then interest on capital and profit loss appropriation account balances on the credit side. Drawings and interest on drawings in the debit side. So the closing balance of B's capital is 2,14,619. This balance should come in balance sheet liability side. Closing balance of B's capital. Unless this B's capital account is drawn, all these adjustments should be exhibited in the balance sheet itself. C's capital account, on July 1, 20, the opening balance was 4,000. Then further 20,000 was introduced in January 1, 38,000. So the closing balance of C's capital is 32,000. Interest on capital 1,080. For the opening balance 4,000 for whole year, and for 28,000 which was introduced in January 1 for 6 months. Now in debit side, drawings 12,000 and interest on drawings 180. Closing balance of C's capital is 1,14,622. That is to be brought down, and that will appear in the balance sheet liability side. Slide 14 shows the balance sheet of ABC and Company on 30th June 2021. This lecture finishes with this slide. Thank you for your participation till the end. I hope everything is clear to a student who follows carefully. Please subscribe and share maximum possible. Thank you once again. Look at liability side of balance sheet. First is current liabilities. It is under creditors, salaries outstanding, and interest on loan outstanding. Then term loans are loan from Dena Bank and loan from Small Finance Corporation. Then comes capital of A, B, and C, the closing balances. On the asset side, first is current assets, cash in hand and cash at bank, sun debtors minus further bad debts and provision for doubtful debts closing balance, closing provision, new provision, sun debtors minus further bad debts and new provision, then closing stock of raw materials, work in process and finished goods, rent prepaid, and commission receivable. Next is fixed assets, furniture and fittings minus depreciation, motor vehicles minus depreciation, tools and equipments minus depreciation. The balance sheet total is 14,91,160 rupees. 14,91,160 rupees. Thank you.